Let's stay on the markets here and bring in Eric Schoenstein. He's portfolio manager at Jensen, where he runs the Jensen Quality Growth Fund. Eric, good to see you this morning here. The market just melted down yesterday. We're seeing some of those gains being recovered today. What's your take on the action here?
Well, Brian, it's nice to see you. I think that what we're seeing is just some continuing volatility that has frankly been a hallmark of the market since the downturn. And, I think there was probably some real concern. If you think about where we were literally Monday, the market was essentially flat for the year, despite a pandemic and devastation economically. And I think, that probably has led some folks to rethink where they've been. And now we're seeing a little bit more volatility, risk on one day, risk off the next. This is the ride that we've been on, and it's probably one we're going to continue to be on until we have more substance in terms of economic and fundamental performance.
Eric, how should a retail investor play this market right now when you see volatility sort of all over the map? We talked about earlier in the show, the VIX index up 50% yesterday, the so-called fear gauge on Wall Street. And we know from apps like Robinhood that the retail investor is out in full force right now. So what are they to do in this environment of such volatility?
Yeah, I think from our perspective, it's really important for investors to know what they own. I mean, when you really understand how companies function, what kind of competitive advantages they have, their ability to internally generate cash flow that funds their growth, those are businesses that will have resilience, they'll be more consistent, and they'll help protect when things get tough, but still be able to grow when things are going quite well. I think that's different than if you think about what's been going on more recently. It's really been more driven by speculation. The entire market is seemingly focused on some very, very large companies and on a prospect of a V-shaped recovery that in theory should be happening, and yet the S&P is projected to be down 37% from 150 something to 110 in terms of dollars of earnings. That doesn't support some of the market moves we've seen, but it does support the idea that if you have good companies, quality businesses, you can actually make proper investments for long-term value creation.
Eric, we've been having this discussion all week. If we are in a second wave or if we are still in a first wave, and the consensus seems to be we are still in the first wave. And just going by that, how much do you think the market's overvalued here?
That's hard to say because it really becomes much more of a stock-specific kind of question. When you have, I think earlier this week, we looked at some data and noticed that Microsoft and Amazon were now 15% of the entire S&P 500. I mean, clearly that's a concentration that would indicate that those two stocks, whether they're specifically overvalued, is sort of more of a measure of what you think the long-term free cash flow and opportunity is. But a lot of companies have been left behind and still are being left behind. And I think that's what's leading to some of the volatility you're seeing yesterday and today. If you've got good companies, I think there still are some good valuable opportunities out there. But I think it's really more about doing your homework. And again, as I said before, knowing what you own. And that requires research and thought as opposed to sort of speculation.
Bouncing off that, can you talk a little bit about those companies or maybe those sectors that have been left behind? Because many of our guests have been talking about how the concentration has been focused in just a few names and how that really isn't healthy for the overall market. So where are you seeing some of those, maybe they're underdogs, we'll call them, in the market right now?
Well, I think, for businesses that do have advantages in their platform, they will be able to come out of this on the other side, but it's going to take some time. So you think about, some of the healthcare names where procedures are not being done. Somebody like Stryker, for instance, which makes orthopedic implants, with the delay in procedures, deferrals of elective procedures. They've had a real struggle in terms of fundamental performance, and yet those procedures will eventually become necessary. And so that's a company that we think will be fine in the long run, but it's been going through some pretty difficult times in the short run. And I think, there's names in the consumer staples space, there's names in the healthcare space. Frankly, there still are some good names in the technology space that maybe have not kept up in the way that some of the big 5 or 6 companies have, but still have advantages in the long term.
Eric, what are you telling clients right now that you may talk to and say, you know what, Eric, we're worried about social unrest sweeping the country. We're worried about election season, and we think the gains have come on too far, too fast. Do you raise cash? Is that the recommendation?
We are fundamental investors in equity. So for us to be in a position where we're thinking about raising cash would really be more about the fact that we don't see any opportunities anywhere within the markets. What we're talking with clients about is understanding what their long-term objectives are, understanding how they're doing against their long-term goals that they have, and really sort of setting aside sort of watching the markets daily and focusing on what their neighbors are doing or their benchmark that they're looking at is doing, and thinking about what do they want to try to achieve, and do they have an appropriate allocation of risk in their overall portfolio to be able to meet those longer term objectives. And if they focus on that, that can frankly relieve perhaps some of the pressure that people feel on a daily basis.
But Eric, even looking longer term, who is the riskier candidate? Is it a President Trump? Is it a Joe Biden? Because I think the thesis out there on Wall Street is that a Joe Biden win means higher taxes, but you re-elect President Trump, and who knows what you get?
Well, I think a lot of that is also going to be dependent upon what happens with Congress as well. I mean, if you have a blue wave, a thin red line, a thin blue line, I've seen so many terms for it recently. I think that's going to be an important element of this too. So, what happens with the Senate, what happens with the president, those are, frankly, we're still months away from that being resolved. And I think it's, the speculation that you just mentioned is probably, aligned with what a lot of people think about. And, we're going to have to pay for all of this debt that we've taken on at some point. That probably means higher taxes at some level. It's just a question of how much. But we'd love to see some more stability, right? And we'd love to see, something that gets more of America unified, certainly. But I think we've got some time to really work through some of that, and some of it's also going to be dependent upon what happens with the virus as we go forward, the handling of that, and it's certainly, some of the other issues that we're facing. I think these are all going to come to the fore more so as we get to late summer, and we can really start to think about that.
And Eric, finally, what needs to happen for this market to rally in a meaningful and sustainable way, do you think?
Well, I think one of the things we need to see is real data. I mean, if I mentioned a minute ago that the forecast for the S&P 500 in terms of earnings this year is to drop from 157 to 110, and yet the markets are essentially not reflecting that kind of drop. And in part, it's because we haven't had most of the actual fundamental earnings data provided that has shown how difficult this has been. And that has, I think, with that vacuum of knowledge or data out there from companies where they've pulled their guidance, they haven't told us what's really been going on, that speculation about how much they're recovering or how fast they're recovering is sort of what's driving some of these market moves. And I think once that starts to play out and we get into second quarter earnings being reported in July and August, then you'll start to hopefully see more of a connection to the fundamentals of what is happening. Now, some of that is going to be masked by the fact that we've had so much stimulus put forward from the Federal Reserve and Congress, so that it's underpinning things sort of similar to what happened with the financial crisis. But nonetheless, more fundamental earnings data, more real business data will start to help, we hope.
All right. Yeah. Wow. We should all hope. Let's leave it there. Eric Schoenstein, portfolio manager at Jensen. Have a good weekend.
Thank you. You too.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.